The recent collapse of Silicon Valley Bank and the U.S. Federal Reserve's decision to raise rates have brought attention to financial stability in the United States. However, there is an important but overlooked fact that has occurred in the past 3 years. The burden faced by U.S. taxpayers due to the national debt has decreased significantly. This development should be taken into consideration by the Fed as it deals with the current situation. Although public debt has increased by $5 trillion during this period, the market value of U.S. Treasury securities has dropped from 108% to 85% of the economy. This rapid decline is one of the quickest reductions in the U.S. debt burden, and it has brought the value close to what it was before the pandemic. Despite the significant decrease in the burden faced by U.S. taxpayers on the national debt over the past 3 years, there has been an increase in financial stress due to the decline. The decline in the burden was at the expense of bondholders, including banks that suffered losses on their bond investments. Therefore, it is necessary to examine how this decline occurred quickly and its implications for financial stability. In simpler terms, the combination of the shrinking tax base, increase in national debt, and near-zero interest rates resulted in a higher debt burden for taxpayers. However, bondholders benefited from the situation as the value of their treasuries increased, and taxpayers had to bear the costs. As a result, the debt burden reached 108%. The economy's size was greatly impacted by the pandemic shutdown but recovered quickly and was back on track by mid-2021. As a result, the debt-to-GDP ratio decreased by about 9 percentage points. Following this, an inflation surge occurred which led to a further reduction in the debt burden by 14 percentage points, bringing it to the current value of 85%. This happened in two ways. Firstly, the high inflation caused the economy to increase by around $1.89 trillion above the pre-pandemic trend. The second channel that contributed to the reduction of the debt burden was the sharp increase in interest rates by the Fed in response to the inflation surge. This caused the market value of treasuries to decrease by approximately $1.9 trillion, which led to bondholders holding bonds that were worth significantly less than what they had anticipated, both in terms of inflation-adjusted value and in comparison to newer securities that offered higher interest rates. To summarize, the reduction in the debt burden was mainly paid for by bondholders due to the high inflation, which lowered the market value of treasuries and caused them to hold bonds worth less than they had expected. Bondholders are also taxpayers, but the loss to them is more significant and apparent than the potential future tax savings for taxpayers as a whole. The transfer of wealth from bondholders was not restricted to the Treasury market alone, as other fixed-income markets such as the mortgage-backed securities market and the corporate bond market also experienced significant losses in market value. As a result, banks, which held such securities, are currently under pressure. According to a recent study, these assets are overvalued by $2.2 trillion due to mark-to-market losses in the U.S. banking system. This implies that many banks may not be able to cover all the claims of their depositors if they decide to withdraw their funds all at once. The fact that banks are under stress due to the loss in market value of fixed-income assets is causing concerns about financial stability. Regulatory authorities in the U.S. are worried about the bank's precarious position and have taken steps to prevent a potential crisis. For instance, the U.S. government has insured all depositors at the recently failed Silicon Valley Bank and Signature Bank, and the Fed has decided to accept loan collateral at face value in its new liquidity facility. The fear is that many bondholders have unknowingly transferred a significant amount of wealth to their debtors, which may leave them unable to afford it. This has created a ticking time bomb on the balance sheets of U.S. banks. The current situation is the result of various factors, but the primary cause is believed to be the Federal Reserve's rapid increase in interest rates over the past year, which it may now pause. This has surprised many bondholders, including the Fed itself, who had expected lower interest rates based on the previous decade's trend. The Fed's aim is to curb inflation, but the rapid rate hikes have had negative effects on banks' balance sheets and credit creation. It is hoped that this will lead to a smooth end to the inflationary period, rather than a financial crisis. The current period is characterized by significant changes and challenges, and the path ahead is not straightforward. However, there is hope that the Federal Reserve can effectively guide the economy through these uncertain times.